If you have been watching Warren Buffett's latest moves, you may feel a little confused. On one side, he is scooping up shares of companies sitting at 3-year lows, doubling down on names many traders call yesterday's news. On the other side, he just cashed out billions of dollars of Apple stock, arguably his most famous win of the past decade. For the everyday investor, that mix can seem like a riddle. Should we copy his buys, copy his sells, do the opposite, or stand aside until the fog clears? The market already feels jumpy. Buffett's zigzag adds another layer of mystery. But there is a clear story behind the headlines, and once you see the pattern, you can use it to guide your own portfolio with far more confidence than the Twitter feed provides. You can literally copy and paste Buffett's strategy, especially his second move, so let's dive in. Start with the cash. After selling hard in 2024, Buffett built the biggest war chest in Berkshire Hathaway history, more than $300 billion. Reporters called it fear. They missed the point. Buffett was stockpiling dry powder so he could hit the buy button the second real value returned. In early 2025, that buy button finally flashed green. The first target was still Occidental Petroleum. He added millions of shares on the quiet when oil dipped under $70, and most traders shouted that crude was dead. Buffett cares less about today's barrel price than tomorrow's cash flow. Occidental throws off billions even at $60 oil, and it owns the most advanced carbon capture projects in the United States. That gives it a foot in the old energy world and the new clean world at the same time. Buffett is betting the transition will take decades, and firms that bridge both sides will mint money all the way. While everyone watched his energy bet, Buffett was loading up somewhere else that almost no influencer covered. He kept buying Japanese trading houses known as Sogo Shosha, Mitsubishi, Mitsui, Itochu, Marubeni, and Sumitomo. They look boring on the surface, a mix of shipping, mining, food, and banking. But boring is Buffett's favourite flavour. These companies sit at the choke points of global trade, they pay fat dividends, and earlier this year they traded at price-to-earnings ratios near 8, while US tech giants flirted with 30 or 40. Buffett flew to Tokyo, met the executives, and promised to keep stakes under 10% so management could run the firms without fear of takeover. In return, he locked in cheap shares and a pipeline of cash flows tied to every container ship, copper load, and grain boat that leaves Asia. It is his classic play: buy the toll booth on the highway, not the car speeding across it. Closer to home, Buffett made 2 domestic moves that revealed just as much about the future. In March, Berkshire disclosed a fresh position in a mid-cap home builder that focuses on entry-level houses in the southeast. Why buy into housing with rates still high? Because high rates have frozen supply even as population growth keeps pushing demand. Builders that control land and can turn out $300,000 starter homes will own the only on-ramp young families can afford. Buffett remembers the fortune he made on housing stocks after the 2008 bust. He sees a slower repeat unfolding now and wants in early. The second domestic move is hiding in plain sight on Berkshire's balance sheet. Cash that once sat idle now lives in 6-month treasury bills, paying close to 5%. That may sound dull until you do the math. On $300 billion, the interest equals $15 billion every year, enough to cover Berkshire's entire payroll and still leave pocket change. Buffett is turning the safest asset on earth into a mega yield, while he waits for fat pitches in stocks. For individual investors, the message is clear. You do not need to force money into stretched tech names when you can earn 4 or 5% risk-free. Park emergency funds in treasury bills, ride the yield, then strike when bargains appear. What do all these buys have in common? They are cash machines bought at unloved prices. They sit outside the hype cycle, yet benefit if the economy keeps grinding forward. That is vintage Buffett, and it tells us how he reads the next phase of the market. He does not predict a crash on a specific date. He simply sees valuations near record highs in fashionable sectors and refuses to pay up. He sees reasonable prices in energy, global trade, housing supply and short bonds, so he loads the truck. If the broad market falls, he has tons of dry powder to buy more. If it drifts sideways, these holdings still pay him rich cash every quarter. Heads he wins, tails he does not lose much. Now, how can you shadow this approach without billions? Step 1. Copy the cash discipline. Build a 3 to 6 month cushion, then sweep any extra savings into a short-term treasury or a money market fund that tracks the Fed rate. You earn a solid yield while you study wider values. Step 2. List companies that still print real profits, yet trade below 15 times earnings. Focus on firms with pricing power and low debt. Energy service companies, railroads, essential REITs, and select insurers fit the bill right now. Buffett is not alone. Quiet value funds have been creeping into the same terrain. Step 3. Watch the capital cycle like Buffett does. When a sector has enjoyed easy money for years, its share count explodes and margins shrink. When that sector starves for capital, think fossil fuels post-2015. Supply tightens and survivors earn super profits. Buffett's picks in oil and Japanese trading groups line up with that thesis. You can ride their coattails or find your own starving sector. Step 4. Keep patience. Buffett waited almost 2 years between heavy buys. Social media will mock you for missing out, while momentum names double, then crash. Let them mock. The point is to strike when odds turn in your favour, not to swing at every pitch. A quick word on Apple, because many people fear Buffett's recent trims. He still holds well over $100 billion in the stock. Selling a slice was risk management, not a vote against the company. Think of it this way. If one position balloons to half your net worth, you shave a little and redeploy. For small investors, the parallel is simple. Do not let any single holding dominate your future, no matter how much you love the product. Where does all this leave the market outlook? Buffett is quietly positioning for a decade of middling index returns, much like 2000 to 2010. Inflation may stay sticky, rates may hover higher than the last cycle, and profit margins for high-growth tech may compress. In that environment, cash flow matters more than fairy tales. Companies that sell real stuff, control real assets, and return dividend streams could double while glamour names tread water. That is exactly what happened the last time the Shiller PE stood above 30, and Buffett knows the rhyme. The takeaway for you is not to mirror every trade line by line. Filings arrive 45 days late anyway. The takeaway is to wear the same glasses. Keep powder dry. Hunt for value where the crowd is not looking. Insist on cash flows that cover you if the market chills. Accept that waiting is an action, not a void. And when frightened investors run for exits because a headline screams recession, be ready with your buy list and your cash like Buffett. No one can promise the next move of indexes, but following the man who beat 12 recessions is better than trusting random tips. Buffett is buying now. Not noisy AI startups, not meme favourites, but steady earners at lazy prices. Copy the mindset, pocket the yield, and let hype roll past. Wealth is quiet, patient, and selective. In 2026, the people who follow those 3 words will look back at this moment as the calm before their own fortune began. But there is also a 4th word that Buffett recommends listening to, which is subscribe. Or we can also add 2 more words, which is like and comment with your idea for more future videos, and I'll see you soon.